It's September 16th. Your coffee's still warm. You open up your inbox, and there it is, an email from your CPA. You owe thousands more than what you expected. You didn't get hit because you made too much money. You got hit because you missed those 5 moves that you could have made before September 15th that would have kept more money in your pocket. In this episode, it's going to be your plan out of hell, the exact playbook to keep the IRS from getting a bigger bite of your income than they should. And I'm not just going to tell you what to do, I'm going to show you exactly how these strategies work so that you can use them immediately, and so you see why having someone implement them for you is the difference between tax savings on paper and money back in the bank. If you run an S-Corp, partnership, or multi-member LLC, this is the last warning shot before the September 15th deadline. My name is Anthony Brister, and I'm the founder of Brister Law Firm, and this is a Wealth Planning Podcast. So let's dive right in. So this is why September 15th matters. Most business owners think that April 15th is their big day, but they're wrong. For pass-through entities like S-Corps, partnerships, September 15th is a real deadline if you filed an extension, and it's the last day that you can get deductions in place before they're locked out. Fix payroll mistakes that could cost you thousands. Adjust estimated payments before Q4 hits. After September 15th, many of these strategies are dead for the year. The tax code doesn't reward procrastination, it rewards proactiveness and preparation. So let's talk about mistake number one that I see, and it's a big one. It's messy or incomplete books. Messy books are like a leaky bucket. Every missing expense is profit that the IRS gets to tax. Before September 15th, you need to run that year-to-date P&L, compare it to last year's. If your meals, travel, office expense, or professional fees are suspiciously low, without reason, there's probably money left on the table, or you're probably missing something. Let me tell you about a quick story. A client came to me on September 12th of last year with a P&L that looked fine on its surface, but when we dug into it, they had forgotten over $18,000 in reimbursable expenses, and at their tax rate, that was almost $6,000 extra to the IRS. Money that they didn't need to pay. We were able to recover that, but otherwise they would have lost that $6K. Here's the easiest win that you'll ever get, and it's the accountable plan. It's an IRS approved way for your business to reimburse you tax-free. So think home office, internet, phone, mileage, and more. Your business gets that deduction and you get the cash, and you don't have to pay income tax on it. But it has to be documented and in place before you file. Last year, one client implemented an accountable plan and shifted over $9,400 in personal expenses into the deductible business expenses, instantly saving them thousands. By now, and write it off now. If you know the rules, if your business legitimately bought items at the end of the year, like equipment, furniture, computers, and you place it in the service before the end of the year, you can deduct either all of that cost or potentially up to 60% of the cost under bonus depreciation or Section 179, or just through plain expensing the item. It just depends on what that item is and the useful life of it. The key, though, is strategic buying and not panic spending. I see people all the time go out and buy something that they don't need. Here's the pro tip, though. Run the numbers before you spend. You should never buy just to get a write-off. You buy because it benefits the business and it reduces the taxes. Now, if you have a solo 401k or SEP IRA, you can still make employer contributions right up until your filing date. That means before September 15th, you can move thousands from taxable income into retirement, lowering this year's tax bill and building future wealth. One of my clients moved over 30,000 into their solo 401k, which not only dropped their taxable income, but it also kept them under the QBI deduction phase out, saving over 12,000 in taxes. That's just through strategic allocation, right? Think about little things like that that you could be missing. Mistake number 3 that I see are wrong S-Corp salaries. In an S-Corp, your salary isn't just payroll, it's a tax lever. Too high, and you overpay in Social Security and Medicare taxes. Too low, you risk the IRS reclassifying your distributions as wages and hitting you with penalties, or maybe even missing out on that QBI deduction. The goal is a reasonable compensation that's defendable number based on industry data, duties, and responsibilities. This is one of the fastest ways to save thousands without raising any IRS red flags. The 4th mistake I see is ignoring estimated tax payments. September's estimated payment is your last big chance to adjust based on actual year-to-date income. Overpaying gives IRS an interest-free loan, and underpaying racks up penalties and interest. Either way, you lose. I've had clients reduce Q4 estimates by $15,000 just by doing a projection now and freeing up cash to reinvest in their business. The 5th mistake that I see is filing without a pro and without a pro reviewing them. The most expensive return is the one that no one's double checked. I found 10 to 30K in savings and returns for clients that they thought were perfect. Think missed depreciation, unclaimed credits, expenses misclassified. Once you file, those dollars could be gone unless you amend, and the amendment invites more scrutiny. Another big thing that can come up is the QBI deduction. The QBI deduction can be up to 20% of your qualified business income, but it phases out at certain levels. So payroll adjustments, retirement contributions, or shifting expenses can bring you back under that limit. And one small adjustment saved a client over $18,000 in federal taxes. September 15th isn't just a suggestion, it's a guillotine. And you miss it, you lose those strategies for the year. You also risk penalties, interest, and a tax bill that makes your stomach drop. The tax code is written for early movers and those who actually take action. You've got the strategies now, but let's be honest, most business owners won't implement them on their own. Not because they can't, but because they don't have the time. And that's where we come in to execute these moves before the clock runs out. So what's worse, paying the IRS more than you owe, or knowing that you could have stopped it? Regret is expensive, and I've seen it in the eyes of clients who came to me after that deadline, knowing that they left $10, $20, or even $50,000 on the table. This is your plan out of hell, but you want to make sure that you fix your books, you implement those deductions, you optimize your payroll, you adjust your quarterly estimates, and then you review your return for missed savings. We can do all of this for you before the September 15th deadline, but only if you reach out now. Thank you for watching. My name's Anthony Brister again, and if you found this helpful, give this a thumbs up, drop a comment with your question. I always respond. Hit that subscribe button so you don't miss the next episode. All the links and tools are in the description below. If you know someone who needs this before the deadline, share it with them. I'll see you on the next one.